Welcome to video 5 of part 2 of the EA Tax Training free EA exam prep course for 2025. Tom here, back with you to discuss sole proprietorships and partnerships. Up until now, we've been talking about things that affect all businesses, such as income, expenses, asset basis, etc. But in these next few videos, we're going to get into the specifics of each different type of taxable entity, obviously starting with this one, covering both sole proprietorships and partnerships. Our free resources from irs.gov, the list is fairly short, but they are all in bold. I do recommend all of these. We've got 2 for sole proprietorships and 2 for partnerships. For sole proprietorships, we've got Schedule C of Form 1040 along with its instructions and IRS Publication 334. For partnerships, we've got Form 1065 and its instructions along with Publication 541. So let's get started by discussing sole proprietorships. Specifically, what we will cover is an overview of Schedule C. Then we will talk about owner's pay, then self-employment tax. Then we'll move on to health insurance. And finally, we will talk about retirement. As a recap of sole proprietorships, remember it includes single-member LLCs unless that LLC elects to be taxed as a corporation, such as an S corporation. But if someone just files a single-member LLC, doesn't do anything else, then they will be taxed automatically as a sole proprietorship. That is considered a disregarded entity for income tax purposes. Sole proprietors file on Schedule C of Form 1040, so there is no separate tax return. And this also includes a qualified joint venture that you'll remember we talked about back in video 1. Technically, it is a partnership. However, if they meet certain requirements, they can file instead on Schedule C. So this is for a married couple who does not have any type of entity. So they did not go to the state and file an LLC or any other type of entity. And both spouses must materially participate in the business, and they both must agree to file as a sole proprietorship. If they do that, then they file 2 Schedule Cs, one for each of them. They each report their share of the income and expenses on their own Schedule C, and then they also file separate Schedule SEs to report self-employment tax. Any business owner who has more than one sole proprietorship should put each separate business on its own Schedule C. So sometimes this can be somewhat subjective. Do we include these 2 businesses together or don't we? So as a general rule, if they're in the same general line of business, then it's probably okay to put them on the same Schedule C. But if you've got 2 very different businesses, then they should be on separate Schedule Cs. For a Schedule C, the income flows, of course, to the 1040 because Schedule C is part of the 1040, and all of the income is taxed at the individual tax rates. Let's take a look at Schedule C. So you can see here, starting at the top, you put in the basic information. If you don't have a separate business name, you're just doing business under your own name, then you can just leave that part blank. And then you can see you're going to say what accounting method you're using and answer some other questions that they want to know about. Then the income section, we have seen this before, so you can see where you report all of your income. And then we have our expenses. You may have some of these. You probably won't have all of them, but you fill in the ones that you have. You may have other ones that are not listed here. So those would go on this line as other expenses. And then we'll see on the next page, there's a place where you can list out what those other expenses were. Then you will come down to your total expenses, your profit. It does have a spot for the home office deduction if you are taking that, and that will leave you with your net profit or loss. And then it's going to remind you about a few things, including Schedule SE. Then page 2 of Schedule C. At the top here, part 3 is cost of goods sold. So you're going to say what method you're using. Remember, cost is most common. That's LIFO, FIFO, or average cost are all cost methods. If you changed that method during the year, you're supposed to check this box. Of course, you should also then be filing that Form 3115 for the change in accounting method. Then you're going to detail out your cost of goods sold. Remember, it is beginning inventory plus purchases minus ending inventory. So this is going to give all the details of that and leave you with your cost of goods sold. And then part 4 is information for your vehicle. So if you are using a vehicle in your business, then they want to know some information about that vehicle, including how many business miles you drove, whether or not you kept a log, et cetera, and so forth. And then finally, here, part 5 is that place where you can list out the specifics of what those other expenses are. Owners pay for a sole proprietorship. The owner is not on payroll. Even if there are other employees who are on payroll, the owner does not go on payroll. Instead, they take their pay by making withdrawals from the business bank account, and their taxable income is not dependent on the amount of those draws. The tax is paid on the profit of the business, whether they take the money out or not. So that profit could be more or less than the amounts that were withdrawn. Self-employment tax, we've discussed this a couple of times, both in part 1 and part 2, but just as a recap, it is reported on Schedule SE, and up to $168,600 in 2024 of net earnings from self-employment are subject to the Social Security piece of the self-employment tax. So that is the 12.4% out of the total 15.3%. That will apply to the first $168,600 of net earnings from self-employment. If you've got earnings above that amount, then you do not have to pay that 12.4% on those amounts. However, for the Medicare portion, the 2.9% of the self-employment tax, there is no cap on that. So you pay the 2.9% on all of your earnings from self-employment. And remember, half of the self-employment tax is deductible as an adjustment to income on Schedule 1 of the Form 1040. That is comparable to the employer's share of Social Security and Medicare if you had an employee. A reminder of how the calculation is done: net earnings from self-employment means self-employment income times 92.35%. So, for example, Leo has a Schedule C business with $60,000 of revenue and $23,000 of expenses. His profit is $37,000. His net earnings from self-employment are that $37,000 times 0.9235, which equals $34,170. So Leo owes self-employment tax on that. 15.3% of that amount is $5,228. And remember, the reason we multiply by 0.9235 is because one half of the self-employment tax is deductible, but that's not reflected on the Schedule C itself. So it's not deducted as a business expense on Schedule C. It's deducted as an adjustment to income on the 1040. So by multiplying it by 0.9235%, that is taking out 7.65% of the income, which would normally be the employer's share of Social Security and Medicare. So that is why that happens, and that is how that works. Health insurance for a sole proprietor. Premiums that are paid for the owner's health insurance and other fringe benefits are not deductible on Schedule C. So if you've got employees and you're paying for their health insurance or fringe benefits, those are deductible, but not for the owner. Remember, the owner is not an employee. They are not on payroll. However, self-employed health insurance premiums are deductible if you meet certain requirements that we will remind you of as an adjustment to income on Schedule 1 of the 1040. And also, limited amounts of long-term care insurance can also be included as part of that deduction. So as a reminder of how the self-employed health insurance deduction works, you must be self-employed and not eligible for subsidized health insurance from your or your spouse's employer. So if you've got a regular job and this is a side business and you can get health insurance, subsidized health insurance through your employer, then you cannot take the self-employed health insurance deduction. Similarly, if your spouse has access to subsidized health insurance that you could be on, then you cannot take this deduction. In addition to that, you have to have a profit from the business in order to cover the deduction. So in other words, the self-employed health insurance deduction cannot cause you to, in effect, have a loss from your business. So you can go to zero. You can use as much of the health insurance premiums as you need to get down to zero, but you cannot go below zero. Another way a sole proprietor can get health insurance is If their spouse works in the business, so the spouse is an employee, then if the business offers health insurance to their employees, the spouse can buy a policy in their name, and then the owner gets coverage as the spouse of the insured. So the sole proprietor is the spouse of the employee, and so the sole proprietor can get coverage by having their spouse be an employee. Of course, they need to be an actual legitimate employee who is actually working in the business. Owner's retirement contributions to SEP, simple, and qualified plans for the owner, again, are not deductible on Schedule C, but they are allowed as an adjustment on Schedule 1 of the Form 1040. The SEP, the self-employed pension, the owner can contribute up to 25% of their net earnings from self-employment up to a maximum of $69,000 for 2024. This is a pretty good deal. A sole proprietor can put up to $69,000 away for retirement as part of a SEP. Now, it is only a maximum of 25% of your net earnings, but still, that is a good deal. And these plans are very simple to establish. Another type of plan is a simple IRA. In this one, the proprietor can contribute all of their net earnings from self-employment, but only up to a maximum of $16,000 for the year, plus an additional $3,500 if they are age 50 or older. So it would be a total of $19,500. These plans are set up through a financial institution, but they need to be set up between January 1st and October 1st of the year you want it to be effective, unless you became self-employed after October 1st, in which case you just need to set it up as soon as it is administratively feasible to do so. 401k plan. If this is a side business and the proprietor has a job with a 401k plan, they can contribute to their normal employer's 401k plan just like everybody else. So that's up to that maximum contribution of $23,000 for 2024, or an additional $7,500 if they are age 50 or older. In addition, they can contribute up to 25% of their net earnings from self-employment up to that $69,000 maximum. Now, that $69,000 maximum is the combination of the amount they contribute to their regular employer's plan plus the amount that they contribute to their own plan. But still, again, they can get up to that $69,000 as a retirement contribution for 2024. If they don't have any other employees, they can set up a solo 401k plan and they can make contributions up to these same limits. There are other types of retirement plans: profit sharing plan, money purchase plans, defined benefit plans. These are not very common with sole proprietors. You are usually not going to see them, but we will talk more about retirement plans in video 9. Moving on now to partnerships. So before we discuss partnerships, we do need to have a little bit of a conversation here. Partnerships can be very complex. I'm talking about in the real world. So that's the bad news. The good news is, for purposes of the EA exam, you're only going to be tested on the simpler concepts. But I want you to know that when you're out doing tax returns, if you have a potential client come to you and it's a partnership, well, if it's a very simple partnership, a couple of friends just got together, started a little business, it might be fine. But you're going to want to look at their prior year tax returns and what their structure is, because if they've got a very complicated one, if you're not an expert on partnership taxation, you might want to refer them off to somebody else. So you're just going to have to look at it, see what you're comfortable with. But I just want you to realize that because of all the different rules and all the different types of partners you can have, and the fact that you can have dozens, hundreds, thousands of partners, it can make these partnerships very complicated. As a matter of fact, there are tax professionals, CPAs, and attorneys who dedicate their entire business lives to dealing only with partnerships. So they tend to work for big firms and they work on big partnerships, but that's all they do, because this area of law can be so complicated that it takes that much expertise to get it done. Again, I don't want to scare you, because for the EA exam, It is pretty simple. It's pretty straightforward. I just want you to keep this in mind for when you are out in the real world. So now that I have scared you, let's move on and talk about partnerships. What we will cover are partnerships in general, and we'll do an overview of the Form 1065. We'll talk about partners' pay, profits, losses, and separately stated items, contributions and distributions to and from a partnership, basis, both inside basis and outside basis. Then we'll talk about the disposition of a partnership interest, and then we will look at some schedules. We'll look at schedules K, K1, K2, and K3, and schedules L, M1, M2, and M3. And then finally, we will discuss a couple of miscellaneous partnership topics. As a reminder and overview, a partnership is when two or more people and or entities enter into business without incorporating. So two people or two entities start a business, they don't go to the state, they don't file anything, they are defaulting to being a partnership for tax purposes. As you'll remember, there are some other types of entities that will also be treated as partnerships. A multi-member LLC, if they do not file an election to be taxed as a corporation, then they will default to being a partnership. And similarly, a limited liability partnership or a limited partnership will default to being taxed as a partnership. As a reminder, the partnership itself generally does not pay tax. There can be exceptions that we'll talk about, but generally the partnership itself does not pay tax. Instead, the profits and losses pass through to the partners and are taxed on their separate tax returns. So it is called a pass-through entity along with the S corporation. For simplicity's sake, I will often speak of the partners as if they were individual taxpayers. It's just easier to discuss and it's more relevant to what you are likely to be tested on the EA exam. But just know that C Corps, S Corps, estates, trusts, and even other partnerships can be partners in a partnership as well. Now, all the same general principles apply. The income still flows through, they still show it on their own tax returns, etc., and so forth. But it just makes it that much more complicated to talk about. So as we talk about it, unless I say otherwise, we're just going to assume that the partners are individual human beings who are filing Form 1040. And then if we need to talk about when entities are involved, we will talk about that separately. So let's have a look at the Form 1065. We will start here at the top with the calendar year or a fiscal year. So right away, we're going to start talking about what if you don't have an individual as a partner. If you've got individuals who own the majority of the partnership, of course, they are in a calendar year. So you don't have to worry about this. If you are using a calendar year, you leave this up here blank. However, let's say you have a corporation who is a majority partner in the partnership. As you will recall, if that happens, the partnership has to use the corporation's year end, which may not be a calendar year end. So if that's the case, then you would put the beginning date and the ending date of the tax return. If it's just a calendar year corporation, then you can just leave that blank. Then we move down to the normal types of things that you need to fill in. You can see you've got some check boxes that you need to fill out. Then we see the income section, which we have looked at before. We're going to list all your income. Then there is the deductions, and you've got all of these categories. Here, if you have other deductions, then you are going to attach a statement. There's not a place on the 1065 itself to put those. You will attach a separate statement that shows what all of your other deductions are. Then you'll come down here and you'll see that it is possible to have a total balance due. So as we said, generally, the partnership does not pay any tax itself, but there can be exceptions. And so if that is the case, you will show that here, and we will talk a little bit more about that later. The filing deadline for the 1065 is the 15th day of the third month following the end of the tax year. So that is March 15th for a calendar year partnership. Remember, the pass-through entities, the partnership and the S Corp, are a March 15th due date for calendar year entities. However, of course, you can request a 6-month extension by filing Form 7004. The penalty for late filing a return is $245 per partner per month. So if you have a lot of partners, this could get very expensive. Even if you only have two partners, because that would be the minimum, then you're talking about $490 per month or part of a month for up to 12 months as a penalty for late filing. When you look at the individual tax return, and when we look at the C corporation tax return later, we'll see that the late filing penalties are based on the amount of tax that is due. Well, since a partnership generally doesn't have any tax due, that doesn't make any sense. So instead, they just put this flat fee per partner per month in there, and it can potentially get pretty expensive. There is also a separate penalty for failure to furnish an information return. So we'll be talking about these, about the K1 and the K3. But if you fail to furnish those returns, it is $330 each, and it is $660 each if it was done intentionally. So remember, you can have partnerships with hundreds or even thousands of partners. So these dollars really could add up very quickly. And you can see the maximums here. Those are big numbers, but for very large partnerships, they might approach those numbers. So the IRS is not fooling around here. They want you to be filing these returns and sending out the K1s. Now let's turn our attention to partner pay and pass through items. So, how do partners in a partnership get paid? Well, if they are active in the business, so they're working in the business, then they do get paid, but they are not on payroll and they're not subject to payroll taxes or withholding or anything like that. Instead, the payments they get are called guaranteed payments. And they are guaranteed in the sense that they are made whether or not the partnership is profitable. So, usually you start a partnership. The idea is you're going to start this business. Hopefully, you're going to make a profit, and then you are going to share in the profits and you're going to distribute out the profits. Well, these payments are not because you are an owner of the business. These payments are being given to you because you are working in the business. So it doesn't matter if the business is profitable or not, you are still going to get this money. So that's why the payments are called guaranteed payments. As far as the partnership is concerned, guaranteed payments are treated as if they were paid to a third party. Therefore, they are deductible by the partnership. And of course, they are taxable to the partner. So, as far as the partnership is concerned, it's a lot like salary, except it doesn't go through payroll. You don't have withholding. But the payments, the guaranteed payments made to the partners, are deductible by the partnership. Guaranteed payments can be for services rendered, as we've been discussing, but they can also be for the use of capital. It's not as common, but it could be that the partner is letting the partnership use a building or even cash. And so they will make a guaranteed payment that more or less replaces rent or interest, for example. That again is not as common. So when I'm talking about guaranteed payments, as we're going through this video, unless I say otherwise, you can assume it is one of these guaranteed payments for services rendered, which is the much more frequent situation. For the partner, guaranteed payments for services rendered are considered self employment income. Again, if they're guaranteed payments for the capital, they're not self employed income, but for services rendered, they are. They will be reported to that partner on their Schedule K1, and then the partner must file a Schedule SE on their 1040, just like a sole proprietor, and pay the self employment tax. And they can also deduct self employed health insurance, just like a sole proprietor, as long as they qualify. And fringe benefits paid to partners by the partnership are generally considered guaranteed payments and therefore taxable. So remember, we talked about all those fringe benefits for employees that may be tax free. That does not apply to partners in a partnership. There are some exceptions, but for the most part, fringe benefits are considered guaranteed payments and therefore are taxable to the partner. Now let's talk about the partner's share of the profits. The partnership agreement will spell out the percentages of profits to be allocated to each partner. So hopefully there is a written partnership agreement in place. As we discussed, that is the best practice, but there may not be. There may just be a handshake like, okay, we are 50-50 or whatever the percentages are. But whatever the agreement is, the profits will be paid out according to those percentages. And those profit percentages can be different than capital percentages. So, for example, Abe and Ben form a partnership with Abe contributing $1,000 and Ben contributing $99,000. Since Abe has the expertise needed to run the business, The partnership grants 25% of the profits to Abe and 75% to Ben. So for capital purposes, Ben is 99% and Abe is 1%. But for profit and loss purposes, Ben is 75% and Abe is 25%. The reason this is important is because this is different than with S corporations. With S corporations, these two cannot be different. The profit and loss percentages must be the same as the capital percentages. As I mentioned in an earlier video, a common decision point for people who are starting a business is, should we be a partnership or an S corporation? This is one of those things that might make them lean toward being a partnership if they want to do this, if they want to have this disparity between capital percentages and profit and loss percentages. In any case, profits will flow through to the partner's separate income tax returns via a Schedule K-1 from the 1065. And remember, the profits are taxable even if no cash is distributed to the partners. So they have to pay tax on the profits that are reported to them on their K-1, even if they didn't get any cash out of the partnership in order to pay the tax on those profits. And then also, if there are losses, the partners can take those losses on their tax returns, assuming that they have basis in the partnership. And we will talk more about that here coming up. Separately stated items. Some items of income and expense are not recognized by the partnership itself. They will not be on that page 1. When we looked at the 1065 and we saw all the income items and we saw all the expense items, there are some items that will not be included in those numbers. Instead, they are passed through and separately stated on each of the partners' K-1s so that they can recognize those on their own Form 1040s. So they will be reported by the partnership on Schedule K, but that's not part of that page 1 that we saw. It's a separate page. So they will be on Schedule K, and then they will be allocated out to the partners on Schedule K-1. We will be looking more at that a little bit later. Some examples of these separately stated items: portfolio income, interest, dividends, capital gains, and losses. Remember, those are not included in the income section of the partnership return. Those are separately stated items. Section 179 deductions that we talked about on the previous videos, not included in depreciation expense on page 1 of the 1065. Those are separately stated. Charitable contributions, separately stated. And then also all of the information needed for that QBI deduction that we talked about in part 1 will be also separately stated on each partner's K-1. So let's do an example of separately stated items. STL Partnership, which is owned equally by Stan and Lee, has revenue of $200,000 and operating expenses of $125,000. They also have a $20,000 179 expense and a $2,000 charitable contribution, which are not included in the operating expenses. Their operating income is shown on page 1 of the 1065 is $75,000. That's the $200,000 minus the $125,000 of expenses. In addition, Stan and Lee will each be allocated $10,000 of the 179 expense and $1,000 of the charitable contributions for a possible deduction on their 1040s. Whether or not they can actually deduct those things is going to depend on their own particular tax circumstances, but they will be reported to them on their K-1. Related party transactions. A partnership cannot deduct a loss on the sale of property to a related party. And a related party includes a partner with direct or indirect ownership of more than 50% of capital or profits, another partnership or an S Corp if the same person owns more than 50% of each, and then any family members that you see there on your screen. So this is another one of those related party rules where the IRS doesn't want people manufacturing losses by selling property back and forth. So the partnership is not allowed to recognize a loss on the sale of property if it is to one of these related parties. So let's talk for a minute about this direct or indirect ownership and what that means. Sometimes a partnership will have as partners individuals, and there could also be trusts and, of course, other entities. So let's say you have an individual that owns 30% of the partnership. And then that individual also has a trust that they are the grantor of and possibly also the beneficiary of that trust. And that trust owns 30%. So together, if you look at the individual and their trust, they own 60% of the partnership. So that would be considered indirect ownership of more than 50% of the profits. So again, the partnership would not be able to deduct a loss on a transaction with that individual or with that trust. Now we will talk about contributions to and distributions from partnerships. Partnerships are typically formed by the partners contributing cash or other property. The partners get basis in the partnership based on their contribution. For cash contributions, their basis in the partnership is equal to the amount of cash contributed. I think that makes sense. For property contributed, their basis in the partnership is equal to their adjusted basis in the property itself minus any debts that are assumed by the partnership. So if they give a building and the building has a mortgage and the partnership is going to assume that mortgage, then you have to subtract that from the adjusted basis in order to determine the partner's basis in the partnership. But discounting that, if they are contributing something other than cash, then their basis in the partnership is the same as their adjusted basis in the property itself. Generally, neither the partner nor the partnership recognizes a gain upon the contribution of property to a partnership, and the partnership inherits the adjusted basis and the holding period of the partner. So if the partner contributes that building, the partnership now owns the building, and their basis is going to be the same as the partner's adjusted basis. And they are going to step into the shoes of the partner as far as holding period goes. So if the partner had held that for more than 1 year, then that is going to be a long term asset in the hands of the partnership. There can be something called a disguised sale. So, in certain circumstances, a partner's contribution of property and subsequent receipt of a distribution from the partnership can be considered a disguised sale. In this case, the partner recognizes gain and the partnership recognizes the purchase of an asset. So, what are we talking about here? We can have a situation where the partner contributes, let's say, that building to the partnership. So they are quote unquote contributing the building to the partnership. And then a little while later, lo and behold, magically, they get a distribution from the partnership. So let's say they contribute this building. It has a $100,000 adjusted basis. It's got a fair market value of $200,000. They contribute that to the partnership. And then a few months later, the partnership makes a $200,000 distribution back to the partner. The IRS is saying, no, 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 guys, you can't do that. That's not actually a contribution to the partnership. You were just selling that building to the partnership and trying to make it look like a contribution. It is a sale disguised as a contribution. The gain for the partner will be computed as the fair market value of the property on the date of the contribution minus the partner's basis at the time of that contribution. And then, of course, the partnership itself will now have an asset, and the basis will be the full fair market value. So, when will these disguised sale rules kick in? If the partner contributes property and the partnership makes a distribution of different property, including cash, to the partner, and both of the following are true, then it will be a disguised sale. So both of these things have to be true. First, the distribution would not have been made but for the contribution. So if the contribution had never been made, the distribution never would have been made. That's the first thing. And then secondly, the partner's right to the distribution does not depend on the success of partnership operations. So normally you're getting distributions from the partnership because the partnership is making money and you are getting your share of that. But if this distribution had nothing to do with the success of the operations of the actual business, it was just, yes, we are going to give you this $200,000 distribution, then that will be considered a disguised sale. If this contribution and distribution occur within 2 years of each other, it will be presumed to be a disguised sale unless the facts and circumstances clearly demonstrate it was not. And it would be very difficult to prove that this was not, in fact, a disguised sale. So just remember these rules. The partner is contributing a building, they are getting back a distribution. That's a distribution they would not have gotten if they had not contributed the building. The distribution had nothing to do with the success of the partnership operations. Then it will be a disguised sale. And if those two things happen within 2 years of each other, they will be presumed to be a disguised sale. It could be longer than 2 years and still be a disguised sale. But if it's within 2 years, then it will be presumed to be a disguised sale. Contribution of services. A partner can acquire an interest in partnership capital or profits as compensation for services performed or to be performed. A capital interest would give the partner a share in the proceeds if the partnership's assets were sold and the proceeds distributed to the partners. So this is equity. A capital interest in a partnership we call equity capital or capital accounts. So that's what we're talking about here. It's equity. Remember, assets equals liabilities plus equity. So if you shut down the business, sold all the assets, paid off the liabilities, what's left goes to the owners. That is their capital interest. A profits interest, on the other hand, is any interest other than a capital interest. So, for example, an interest in a share of any profits, and that's generally what it is. If an individual receives a capital interest in exchange for services, the fair market value of that interest is a guaranteed payment and is taxable income to the partners. So if they're getting an equity interest, then that is taxable to the partners. On the other hand, if they're receiving a profits interest in exchange for their services, it is not a guaranteed payment and it is not taxable. There are some exceptions there that I will let you read on your own. But the main thing you want to remember is if they receive a capital interest, it is taxable. If they receive a profits interest, it generally is not taxable. Distributions from a partnership. So distributions may be made to a partner for a variety of reasons. Could be a distribution of current or prior earnings, could be a distribution to pay taxes on earnings, could be a distribution in anticipation of earnings, could be a complete or partial liquidation of the partner's interest, or it could just be a liquidation of the partnership itself. Distributions received do reduce the partner's basis and their capital account. So we will talk more about those later, but we do want to remember that distributions reduce both basis and capital accounts. Distributions of earnings are not taxable per se. Tax is paid on the profits regardless of distributions. We've said that a couple of times now. So it's not like we look at how much did you get out of the partnership cash-wise, and that's how we determine the tax. We determine the tax based on their share of the profits of the business, regardless of how much they took out in distributions. Distributions of money in excess of the partner's basis in the partnership are taxable to the partner as a capital gain. So they have a basis that we're going to be talking about. If they get more money back, so they get all of their money back, their basis back, so everything they've invested in essence, plus they get more than that, then that excess is a capital gain. Distributions of property other than money generally do not result in a gain until the partner disposes of the property. And this is new for 2024, so you might want to take note of this. They might want to ask a question on this. For distributions of non-cash property, the receiving partner must report the distribution on Form 7217. This is a brand new form for 2024. It's the partner's report of property distributed by a partnership, and it is used to report the adjusted basis of the property that was received. There are some times it is not required, so it's not required for distributions of money or marketable securities that are treated as money. It's not required for guaranteed payments for services, and it is not required for transfers that are treated as disguised sales. But other than that, if you get something other than cash from the partnership, then you need to fill out this Form 7217 and attach it to your tax return. Now let's talk about basis. We've already mentioned basis a few times, so let's get into the specifics. In a partnership, there are two types of basis: inside basis and outside basis. And you will want to know the distinction. You will get questioned on this. The inside basis is the partnership's basis in its assets. Just like any other business has a basis in its assets, that is the inside basis. The outside basis is the partner's basis in the partnership itself. So the partnership itself is a type of property. And so the partners will have a basis in that property. So that is the outside basis. The outside basis is important in order to determine deductible losses that flow through from the partnership. The gain on distributions in excess of basis. Remember, we said if you had a distribution of money in excess of basis, then that is taxable. Well, we need to know basis in order to determine that. And then also, we need to know basis in order to determine a gain or loss if the partnership interest is sold or otherwise disposed of. So inside basis, again, means the partnership's basis in its assets. So for example, partner A contributes a building with a fair market value of $200,000 to form a partnership with partner B. Partner A's basis in the building at the time of the contribution is $100,000. The partnership now has a building on its balance sheet with a basis of $100,000. That is the inside basis of the building. So remember, the partnership inherits the adjusted basis and the holding period of the partner when this contribution is made. So their inside basis in that building is $100,000. Partner B contributes $100,000 cash for her share of the partnership. The partnership uses $50,000 of that to buy equipment. The partnership's inside basis in its assets is now $200,000, $100,000 for the building, $50,000 for the equipment, and then $50,000 of cash that is still in the bank. So now let's look at outside basis. In the previous example, each partner starts with a $100,000 basis in the partnership. Remember, partner A put in the building with an adjusted basis of $100,000. Partner B put in cash of $100,000. So they've each got a basis in the partnership of $100,000. So the total outside basis is $200,000, which matches the inside basis. But over time, both inside and outside basis are likely to change and to change differently. Therefore, there can be a significant difference between inside and outside basis. So how does inside basis change? Well, it changes just like any other business. This is no different than what we learned before. So, for example, you can make improvements to the property, take depreciation deductions for the property. You may have other deductions such as theft or damage that you take a tax deduction for. That reduces the basis. You may get insurance proceeds for the asset. That reduces the basis. So all the normal things that can increase or decrease basis for any other business can increase or decrease the inside basis for a partnership. What about outside basis? Outside basis is increased by the following: additional contributions, including an increased share of or assumption of partnership liabilities. We're going to talk about partnership liabilities on the next slide in a little bit more detail. But this also includes a partner personally guaranteeing a partnership loan as long as certain criteria are met. So obviously, if the partner makes additional contributions, that is going to increase their basis. But also, if they have an increased share of liabilities, that will increase their basis. Then the partner's share of taxable and non-taxable income increases basis. So they are going to have income flow through to them on the K1, some of it taxable, potentially some of it non-taxable. Either way, that increases their outside basis. And then the partner's share of the excess of depletion over the basis of depletable property, unless it's oil or gas wells. So for the exam, just remember excess depletion increases basis unless it is oil or gas properties. Let's talk now about those partnership liabilities. A partner's basis includes the partner's share of a partnership liability, but only if and to the extent that the liability creates or increases the partnership's basis in any of its assets, including cash. So if you get a loan from the bank, for example, you get a $10,000 loan, now you've got $10,000 cash in the bank, so that would count. Or if it gives rise to a current deduction to the partnership, such as trade accounts payable for an accrual basis partnership, or It gives rise to a non-deductible, non-capital expense of the partnership, such as accounts payable for country club dues for an accrual basis partnership. So, of course, country club dues are not tax deductible, but if you accrue the expense, the accounts payable does still count as a liability. Note here, very importantly, accrued expenses and accounts payable do not affect basis for a cash basis partnership. So, why is that? Well, again, this is putting the accrual basis partnership and the cash basis partnership on the same footing. For an accrual basis partnership, when you accrue an expense, that reduces your income. When you reduce your income, you lower the partner's basis in the partnership. So, what this is doing is giving them that basis back. They're saying, okay, you accrued the expense, but the partnership hasn't paid it yet. So now there's an accounts payable on the books. So you get basis for the accounts payable for that accrued expense. So we're reducing your basis for the expense. We are increasing it for the account payable. And so you're ending up back at zero. If you have a cash basis taxpayer, of course, they would not be deducting that accrued expense because they haven't paid it yet. So they have not reduced their basis for that expense yet. So therefore, they do not then get a corresponding increase in basis for their share of the accounts payable. So it is only accrual basis partnerships that have this in effect. One important thing to note is this is different than with an S corporation. So remember, we were talking about partnership, S corporation, which should we choose? For an S corporation, the shareholders do not get basis for their share of the corporation's liabilities. They also do not get basis for guaranteeing a loan of the S corporation. Partners in a partnership do get basis for their share of the partnership liabilities, and they do get basis for guaranteeing the loans of the partnership. So, again, another factor to consider when trying to decide whether to be an S Corp or a partnership. So, now let's look at the things that decrease outside basis, but it can never be decreased below zero. Money and adjusted basis of property distributed to the partners. So if the partnership makes a distribution out to the partners, that decreases their basis. If it is a distribution of property other than money, it is the adjusted basis of the property that counts and that decreases their basis. This also includes a decreased share of any partnership liabilities or an assumption of the partner's individual liabilities by the partnership. So if the partnership's liabilities go down, then the partner's basis goes down. And if the partnership assumes a liability of one of the partners, then that partner's adjusted basis in the partnership will go down. The partner's share of partnership losses decrease basis. So income increases basis, losses decrease basis. And the partner's share of non-deductible partnership expenses also decrease basis, just like non-taxable income increases basis, non-deductible expenses decrease basis. And this includes Section 179 expenses, even if the partner cannot deduct all or part of them. So remember, 179 is a separately stated item, and whether or not the partner is able to take advantage of that is going to depend on their particular tax situation. But whether they can use it or not doesn't matter. It still is going to decrease their outside basis. And then finally, we've got more depletion. The partner's deduction for depletion for oil and gas wells up to the proportionate share of the adjusted basis of the wells allocated to the partner. So just remember, depletion for oil and gas wells decreases outside basis. Also decreasing outside basis are the partner's share of foreign taxes paid or accrued by the partnership and the partner's share of the adjusted basis of the partnership's property donation to charity. So if the partnership donates something other than money to a charity, then the adjusted basis of that property will decrease the outside basis of the partners. losses in excess of outside basis. So, losses and deductions from the partnership may only be taken by the partners to the extent that they have outside basis. Any excess losses are suspended until basis increases enough to cover them. So, if you've got more losses than you have basis, you cannot take those excess losses in this year, but they're not lost. Instead, they will be suspended until next year or the year after that, or until whenever you may have an increase in basis in order to use those losses. Also, you have to remember that the at risk limitations and the passive activity loss limitations also apply to partners in a partnership. So you've got to look at all of these things. If the partnership has losses, you've got to make sure that first, do they have amounts at risk? Secondly, is it a passive activity that we have to worry about the passive activity loss limitations? And then finally, we have to look at, do they have basis in the partnership in order to be able to take those losses? So let's do a couple of examples of how this works. C and D form a 50-50 partnership in 2023 by each contributing $25,000 of cash. The partnership loses $10,000 for the year. At the end of 2023, C and D each have a basis of $20,000. It's the $25,000 they contributed minus their $5,000 share of the loss. In 2024, the partnership has a profit of $20,000. In addition, there are Section 179 deductions of $12,000. At the end of 2024, C and D each have a basis of $24,000. So it is the $20,000 that they started out with from the end of last year, plus their $10,000 share of the $20,000 of profit, minus their $6,000 share of the Section 179 deductions. So that is a fairly simple example of how these basis calculations are done and what you might see on the exam. Example number 2. E and F form a 50-50 partnership in 23 by each contributing $25,000 cash. The partnership loses $40,000 for the year. At the end of 2023, E and F each have a basis of $5,000. So it's the $25,000 they contributed minus their $20,000 share of the loss. In 2024, the partnership has a loss of $20,000. In addition, there are cash charitable contributions of $6,000. At the end of 2024, E and F each have a basis of zero. So it's the $5,000 they started out with, minus the $10,000 for their share of this year's loss, minus the $3,000 for their share of the charitable contributions, which equals minus $8,000. But remember, it cannot go below zero. So E and F can only deduct $5,000 of their loss on the Form 1040s, and the other $5,000 of loss, along with the charitable contributions, are suspended until they have a profit or other increase in basis. So for the exam, these are the types of examples that you should be able to work through. You don't have to know anything too complicated, but you should know the basics of how basis works, what increases basis, what decreases basis, what happens if you have losses in excess of basis. So just be able to work through these simple kind of examples and you will be fine for the EA exam. Moving on from some simple examples to a topic that can be very complicated. So we're going to talk about sections 754, 734, and 743. I am going to give you the simple version, the simple overview. This is what you are going to need in order to pass the exam, but this is another one of those things in the real world that can be very complicated. But again, the good news is you're not going to be tested on all those complicated things. So let's talk about this. When the inside basis, the partnership's inside basis in the assets, and the fair market value of those assets are significantly different, tax inequities can occur in certain situations. So, for example, appreciated property distributed to a partner can cause that partner to be burdened with the entire tax on the appreciation. So let's say the partnership has a building that is worth $100,000 and it has a $40,000 basis. So the inside basis in that building for the partnership is $40,000. Its fair market value is $100,000. Let's say now that that building is distributed to a partner. One of the partners gets that building distributed to them. Well, they now have an asset with a basis of $40,000 because they get the same basis of the partnership. They have a $40,000 basis in that building, but it's worth $100,000. So now if they sell that building, they are going to be taxed on a $60,000 gain. But the fact is, economically, the gain is not all theirs. All of the partners shared in earning that gain. That increase in fair market value occurred while that asset was within the partnership. So all of the partners should have to share the burden of that increase in value. So without Section 754, that one partner would have to pay the entire tax on that asset. A similar disparity arises when a partnership interest is sold or transferred. The new partner can inherit a tax liability for appreciation that they did not participate in. So let's say we've got a partnership, it exists, it has some assets that have appreciated in value. Their fair market value is much larger than their inside basis. So now a new partner comes in and buys in. When they buy in, they're having to pay the fair market value of that partnership interest, which reflects the fair market value of the assets within the partnership. But let's say the partnership now goes and sells one of those assets. Well, they're going to have a big gain on that sale, and this partner is going to get burdened with having to pay for some of that gain, even though they didn't get any of the economic benefit. They weren't around when that asset appreciated in value. And as a matter of fact, they just paid the equivalent of the fair market value for that asset, but now they have to pay tax on the gain because that asset was sold. So again, you have a disparity here because of this difference between fair market value and adjusted basis. And by the way, this can work the other way. Sometimes a partner can get a tax benefit that they are not entitled to. So if the fair market value of the asset is lower than its adjusted basis, then that partner who is getting that distribution gets to take all of the loss on their tax return, even though the other partners actually shared in the economic loss. Or the new partner coming in gets the benefit of a tax loss, even though they didn't suffer any of the loss from the drop in value of that asset. So what sections 754, 734, and 743 are designed to do is to remedy this problem. What section 754 says is the partnership can make an election to adjust the basis of the assets to match their fair market value in specific situations. So this election applies anytime the partnership either distributes property to a partner, that's covered by section 734, or when a partnership interest is transferred or sold, that is covered by section 743. So what this is saying is section 754 says we elect to use sections 734 and 743. When they make that election, if property is distributed to a partner, then they will adjust the basis of the asset to match its fair market value. Or when a partnership interest is transferred or sold, they will adjust the basis of the assets to match their fair market value with respect to that new partner. The mechanics of how you do this can be somewhat complicated. Do not worry about that. Just focus on the concepts. These adjustments of basis normally do not apply unless you make the Section 754 election. So Section 734 and Section 743 do not apply, except with an exception that we'll talk about, but they normally do not apply unless you elect to have them apply under Section 754. Now, you may be asking, why would you not make this election? There's clearly a tax inequity here. Why would you not want to do this? Well, the reason is you may have a very closely held partnership, like a family partnership. Let's say the parents are partners and the minor children or trusts for the minor children are partners. The minor children don't have very much income, they're in a very low tax bracket. The parents have income, they are in a very high tax bracket. Well, remember, we said you could have a situation where the fair market value of the asset is lower than the adjusted basis. So you might want to be able to distribute that property out to the parents, let the parents take the entire tax loss at their high tax bracket and save a lot of money for the family. If you had a 754 election in place, the parents would not get the benefit of that loss. Now, if you've just got a partnership with a lot of unrelated partners, then probably you want things to be fair. You don't want these discrepancies to happen. So you may very well go ahead and say, yes, let's do a Section 754 election. But in those cases, especially when you've got family type of partnerships, you may not want to. The way you make the election, if you want to do so, is by attaching a statement to your Form 1065. And very importantly, it cannot be revoked without IRS consent. And that consent will not be granted lightly. It is very difficult to get the IRS to let you revoke this because they know that people want to play games. They want Section 754 when it's a gain and they don't want to have to pay all the tax on the gain, but they don't want Section 754 when it's a loss because they want to be able to take all of the loss. So the IRS will not easily allow you to revoke this election. So you have to think very carefully before you make the election. And by the way, it is all or nothing. If you make the 754 election, that means from then on, anytime there's a property distribution or a sale or transfer of a partnership interest, then this election goes into effect. The basis of the assets will be adjusted to their fair market value. You don't get to pick and choose. So when you make the election, you need to be thinking about the future and things that might happen before you make that decision, because you have to assume that essentially it cannot be revoked, even though technically it could be. Now let's talk a little bit more about sections 734 and 743. As we said, it can be elected under section 754. And in general, if you don't elect it, then these sections do not apply. However, there is this exception. So it is mandatory to use these sections and to make these basis adjustments if, when there's a distribution of property, there is a substantial basis reduction. What does that mean? If there is a downward basis adjustment of more than $250,000, then you have to adjust the basis, even if you did not make a Section 754 election. So remember, this is where we have fair market value being less than adjusted basis. So if you've got one of those adjustments that's greater than $250,000, then even if you didn't make the 754 election, you still have to adjust the basis of those assets downward to their fair market value. Similarly, when you have a transfer of a partnership interest, if there is a substantial built-in loss, you have to adjust the basis. And it's the same numbers, $250,000. So if the partnership's adjusted basis in the property exceeds the fair market value of the property by more than $250,000, that is a substantial built-in loss. You must adjust the basis. Also, you have to look at it a different way. You have to do a hypothetical liquidation. Say, if we were to liquidate the partnership today, and then we were to allocate out to all the partners gains or losses, if the transferee partner, so the new partner that is coming into the partnership, if that partner would be allocated a loss in excess of $250,000 in this hypothetical liquidation, then you also have to adjust the basis. So just remember 734 and 743, usually not in effect unless you make the 754 election. However, if you've got a greater than $250,000 downward basis adjustment, then you have to adjust the basis even if you did not make a 754 election. If that is confusing, I understand. Rewind this, listen to it again, study the slides, read the resources, and I think eventually you'll see that it does make sense. Disposition of a partnership interest. So, just like with any other asset, a partnership interest can be sold or otherwise disposed of. When that happens, the selling partner has a gain or loss on the sale, and the new partner establishes their basis in the partnership interest. For a sale, the gain or loss is generally a capital gain or loss, but there is an exception. Any part of the sales price that is attributable to accounts receivable or inventory is treated as an ordinary gain or loss. So remember, accounts receivable and inventory are not capital assets. And so any part of the gain that is attributable to them will not be a capital gain or loss. If a partnership interest is abandoned or considered worthless, then the loss is considered ordinary if both of the following are true. First of all, the transaction is not a sale or exchange. And secondly, the partner has not received an actual or deemed distribution from the partnership. So this is when partnerships going out of business, paid off their liabilities, and there's nothing left. There's nothing to give to the partners. In that case, the partners can take an ordinary loss for their basis in the partnership. If a partner retires or dies and receives a liquidating distribution, it will generally be treated as a sale of that interest and therefore result in a capital gain or loss. However, no loss is recognized if any property other than cash, marketable securities, receivables, and inventory is distributed to the retiring partner. So if the partner is retiring and they're going to give him or her a building, for instance, then the partner cannot recognize a loss on that. But if they're only getting cash, marketable securities, etc., then if they have a loss, they can recognize that loss. Partnership cancellation of debt. We did talk about this in a previous video, but we will recap it here. If a partnership terminates and one partner cannot pay his share of partnership liabilities, then the other partners may have to step in and pay on his behalf. If a partner pays any part of an insolvent partner's debt, he or she can take a bad debt deduction. So if that partner who cannot pay is insolvent, meaning their liabilities are greater than their assets, then the other partners can take a bad debt deduction for the amount they have to pay. Now let's look at schedules K, K1, K2, and K3. Schedule K is a summary schedule of all of the partners' share of the partnership's income, credits, deductions, etc. So it is going to show all of the income, whether it's on page 1 or if it's separately stated, it doesn't matter. It will all be reflected on Schedule K. And rental activity is not on the page 1 of the 1065, so it will be reported on Schedule K as well. So here is Schedule K. We will have a look at this. So you can see here, the very first line is ordinary business income from page 1. So on page 1, you had your income and your expenses, and you came down to a net income. That goes here. That is line 1 of Schedule K. Then you can see the net rental real estate. We will talk about real estate more in a later video, but that goes here. And then you have all of these other income and expense items. You've got guaranteed payments. So remember, each partner's guaranteed payments will show up on their K1. And you can see all the various things that are here. Some of these are pretty obscure, and you're not going to be filling them out very often, but they need to be here just in case they are needed by a particular partnership. The last part of Schedule K is actually the top of Schedule L. So we'll be talking about Schedule L here in a little while. But this is the last part of Schedule K. It is called the analysis of net income or loss per the return. So what this is going to do is combine all of the income and expense items from Schedule K, which includes ordinary income from page 1, plus rental income, plus all of those other income and expense items, separately stated or not. They are all going to be combined, and they're going to be reported here. And then you are going to list how much is by corporate partners, individual partners, partnership partners, etc. This is going to be important because later we are going to look at Schedule M, where we are going to reconcile book income with taxable income. For partnership purposes, this is what we mean by taxable income. So we will be reconciling to this number. Schedule K1 shows each partner's separate share of the amounts on Schedule K. So the line item totals from all of the K1s added up together will total to the amounts shown on Schedule K. So Schedule K is for the entire partnership, and then Schedule K1 allocates those amounts out to each individual partner. A copy of each K1 is sent to the respective partner so they can use it for filing their tax returns. And each partner should also get a copy of the instructions. So you are supposed to send, along with the K1, the partner's instructions for Schedule K1. And a copy of all the K1s are also going to be attached to the Form 1065 that is filed with the IRS. So the IRS is going to know what K1s all of the partners receive so they can then match those up with their tax returns to make sure that the partners are all reporting everything that they are supposed to be reporting. So let's look quickly at the Schedule K1. So it starts here with the partnership information, then it shows information about the partner. And you can see some of the things that are here. This can help the partner to determine their basis in the partnership. So this is all reported on their K1, partner's capital account analysis, etc. Then we come over here and we can see these line items. Some of them will look familiar. Remember, line 1 of Schedule K was ordinary business income. So here it is, line 1 on the K1. Then net rental real estate was line 2, et cetera, and so forth. There's not quite as many lines because some of those more obscure things can just be put in this other deductions line or other information, et cetera, and so forth. But this is what the K1 will look like for each particular partner. Schedules K2 and K3. These schedules are used to report foreign source income and expenses of the partnership. Schedule K2 is an extension of Schedule K, meaning it consolidates all of the amounts for the partnership on one form. So Schedule K includes all of the income and expense items. It also includes all of the foreign income and expense items, but they are buried in the numbers on Schedule K. So what Schedule K2 does is it breaks out separately just the foreign income and expense amounts. This goes back to the IRS being worried about people hiding income and assets in foreign type of accounts. So this is another step they are taking to try to discover those things in order to be able to tax them. So Schedule K2 is simply taking the foreign income and expense amounts that are already included in Schedule K and breaking them out separately so the IRS can see what they are. And then Schedule K3 is an extension of K1, meaning it shows each individual partner's share of those same amounts. So it's just like a K1, except it's only going to include the foreign source income and expense items. And like the K1, the K3 is sent to each respective partner. Schedules K2 and K3 do not need to be filed in all circumstances. They do not need to be filed if all of the following criteria are met. First of all, the partnership is a domestic partnership. Secondly, there is no foreign activity, or foreign activity is limited to passive income with no more than $300 of foreign taxes paid or accrued. And that passive foreign income must be reported to the partnership on a Form 1099 DIV. Next, all the partners are U.S. citizens or resident aliens, or estates, trusts, sole shareholder S corps, or single member LLCs owned by and or with beneficiaries who are U.S. citizens or resident aliens. So the partners have to be one of those listed on the slide. If you've got any other kinds of partners, then you must file the Schedule K2 and K3. Next, all the partners are notified when they receive their K1 that no K3 is being furnished. So you're going to give them a heads up. Hey, we are not sending you a K3. You have to tell them that. And then if any partner requests a Schedule K3 within 1 month from when the 1065 is filed, then you do have to go back and issue the K3s. So you tell them, hey, we're not sending you a K3. And one of the partners comes back and says, hey, I know you said you're not sending one, but I actually need one. Then you do need to go ahead and file them. And if a partner requested one year, then you need to assume that they also need it the next year. Now let's look at Schedules L, M1, M2, and M3. On the Form 1065, the last page contains Schedules L, M1, and M2. Schedule L is, of course, the balance sheet per books. That is the same for all the business returns. Schedule L is balance sheet. Schedule M1 is a reconciliation of book and tax income for quote unquote small partnerships. Schedule M2 is an analysis of capital accounts. And Schedule M3 is a separate form, so it's not listed with M1 and M2, separate. And it is a reconciliation of book and tax income for large partnerships. So M1 reconciles book and tax income for small partnerships. M3 reconciles book and tax income for large partnerships. So let's look at Schedules L, M1, and M2. Of course, we already saw Schedule K there at the top, finishing up. But here's Schedule L. This is the balance sheet per books. So you can see it's going to list all of the assets that you would expect to see. And it's got beginning of the tax year, end of the tax year. Then it shows the liability and capital. You can see here partners' capital accounts. So that is the equity section of the balance sheet. And then, of course, total liabilities and capital, which will equal total assets. Next is Schedule M1. This is that reconciliation of book and tax income for small partnerships. So you're going to start with net income per the books. Then you're going to show all of the things that are book to tax differences, things that need to be added back, things that need to be subtracted. And that is going to leave you with the income from that analysis of net income that we saw there on the top of Schedule L from Schedule K. So book income, all of your adjustments, leaves you with your taxable, if you will, income. And that, again, is going to be from line 1 here of the analysis of net income. Then we've got Schedule M2. This is an analysis of the partner's capital accounts. So you're going to start with the balance at the beginning of the year. Then you're going to show any additions, including capital contributed, other additions. And then you're going to show any decreases, including distributions and other decreases. And that will leave you with the partner's capital account at the end of the year. And then when you look back up here on Schedule L, you're going to see capital accounts. You've got last year, remember? You've got beginning of year and end of the year. So when you're looking at this analysis, the first number you're going to see should be the one from the beginning of the year. And then the last number after you've done all the adjustments will be the one that you see at the end of the year. Schedules L, M1, and M2 are not required for all partnerships. So if the partnership satisfies all 4 of these requirements, then they do not need to file any of those schedules that we just looked at. First of all, if the partnership has less than $250,000 of gross receipts. Secondly, if they have less than $1 million of total assets. Thirdly, as long as all Schedule K1s were filed on time, including the extensions. So if you filed after the due date or after the extended due date, then you still have to fill out Schedules L, M1, and M2. But as long as you file them on time and you meet the other criteria, then you do not. And finally, the partnership is not filing and is not required to file Schedule M3. So if you meet all of that criteria, Schedule L, M1, and M2 are not required. If they are not required, then you must check the yes box on line 4 of Schedule B. We'll look at that here in a minute. And these schedules can still be completed even though they are not required. So except for very small partnerships, I do like to fill these out even if they're not required. But for the exam, you need to know these rules and when they are not required. So here's that checkbox on Schedule B. So it's going to show you again, does the partnership satisfy all 4 of these conditions? And again, gross receipts less than 250,000, assets less than $1 million, etc. If so, then you check yes. Even if you go ahead and file them anyway, if you're not required to file them, I'd still go ahead and check yes, just so the IRS knows that you are not actually required to file those. Now let's talk about Schedule M3. Partnerships must file Schedule M3 if any of the following apply. Total assets at the end of the year are $10 million or more. Adjusted total assets for the year are $10 million or more. And for purposes of the exam, adjusted total assets means if you normally keep your books on a cash basis so you don't have accounts receivable, then you need to do your books as if you were on an accrual basis and include things like accounts receivable. And then you need to see, did we have $10 million or more? But for the exam, just remember total assets or adjusted total assets of $10 million or more. Or if gross receipts for the year are $35 million or more, or if an entity partner, which itself is required to file Schedule M3, owns or is deemed to own an interest in 50% or more in the partnership's capital, profit, or loss on any day during the year. So if the partnership has a partner with a 50% or greater interest, and that partner is required to file a Schedule M3, then this partnership also has to file a Schedule M3, even if they don't meet any of the other criteria on their own. So, for example, large corporations also have to file a Schedule M3. So, if one of those is a partner in the partnership 50% or more, then even if this partnership doesn't meet these asset or gross receipts numbers, it still has to file the M3. If the partnership is required to file the M3, then they must also file Schedule C of Form 1065. That's different than Schedule C of 1040. We will look at it here in a few minutes. Partnerships with less than $50 million of assets at the end of the year can opt to complete only Part 1 of Schedule M3. So if you meet one of the requirements and you have to file Schedule M3, but you've got less than $50 million of assets, then if you want to, you can complete only Part 1 of the M3 and then file Schedule M1 instead of Parts 2 and 3 of the M3. And we're going to look at this in a few minutes so you'll see what this means. These partnerships then are not required to file Schedule C. So if they don't fill out all of Schedule M3, then they also don't have to fill out that Schedule C. Partnerships who are not required to complete the M3 can choose to do so anyway. So again, just like with Schedule L, even if you're not required to fill it out, if you want to, you can. But if you choose to, then you have to follow the rules. So let's look at the M3. Starts with some checkbox information, some other information to fill in. Then it's going to talk about some financial information. And then you are going to detail out your book income. So remember, this is to do a book to tax reconciliation. So you're going to show your book income along with your total assets and total liabilities. Then we're going to go to Part 2. And Part 2 is where you start the reconciliation of book and tax income, but it is only income items. So look how detailed this is. This is just income items. You are going to show them those that are different for book and tax purposes. And then, as you may have guessed, the next page is the reconciliation for expense or deduction items. So again, you can see how detailed this is. So this is like that Schedule M1 on steroids. You're showing all of the book to tax differences, but you are showing them in very much detail. Then we have that Schedule C for Form 1065, and you can see it as just check boxes, but these are check boxes that the partnership has to fill out. This is basically giving the IRS information they want in order to determine where they might want to look further if they do an audit of the partnership. So finally, let's move on to miscellaneous partnership topics. First, let's talk about capital accounts. We have mentioned them several times, but in addition to basis, the partnership keeps track of each partner's equity investment in the partnership. This is their capital account, as we saw on the balance sheet. It's the equity section of the balance sheet. But capital accounts and basis are different things. That's what's important here. Theoretically, the capital account reflects the amount the partner would receive upon liquidation of the partnership. So again, assets equals liabilities plus owner's equity. If you were to sell all the assets, pay off the liabilities, how much would the partner get? That is their capital account. It is their equity. Contributions of property are credited to the capital accounts at their fair market value. So remember, for basis, contributions of property were credited to basis at the adjusted basis of the property contributed. But for capital account purposes, it is the fair market value of the property contributed, not the basis. Distributions decrease the capital account just like they do with basis. Capital accounts are not affected by partnership liability. So remember, you get outside basis for your share of the partnership liabilities. Well, that does not affect the capital accounts at all. And capital accounts do increase and decrease with partnership profits and losses. So just like basis, they will go up and down with partnership profits and losses. But the key point here is to understand that capital accounts and basis are two different things, and some things are treated differently between them. And so you will want to remember those for the exam. Now let's talk about the BBA, also known as the Centralized Partnership Audit Regime. This was enacted by the Bipartisan Budget Act of 2015. For years beginning after 2017, there is now a centralized partnership audit regime. So in case of an audit or notice, this allows the IRS to assess and collect tax at the partnership level rather than at the individual partner level. So this is put in place primarily as a convenience for the IRS. So think about this. The IRS does an audit and they find that the partnership owes money. Without this in place, and before this was in place, what the IRS has to do is they have to go to each individual partner and say, okay, you owe this much money. So you're a 1% partner in this partnership. You owe 1% of this amount due. And they have to send a bill to every partner. And remember, you can have hundreds or even thousands of partners. So now they have to send a bill and follow up and try to collect on amounts from all these hundreds or thousands of partners. So what this does is it simplifies things primarily for the IRS. It kind of simplifies it for the partnership as well, but this is basically for the benefit of the government. So what they can do instead is they can just say, okay, we did an audit, there's an amount due, we are going to bill you, the partnership, for this amount, and the partnership then has to write the check. They will bill that amount at the highest individual tax rate, which is 37%. So this whole system can have a negative impact on partners because the tax is assessed at the highest rate, and partners who enter the partnership after the issue at hand took place could end up paying for something that they had nothing to do with. So first of all, let's talk about the tax rates. You could have a partner who is in the 22% tax bracket, but the partnership is being assessed tax at 37%. So that partner is really getting a raw deal because part of their assets, right? The partnership belongs partially to them. Part of their assets is having to pay tax at 37%, even though he is only in the 22%, let's say, tax bracket. So that's one way it can impact the partner negatively. Then the other way is a new partner coming in. So let's say you've got a partner who buys into the partnership in 2024, and the IRS does an audit of the 2021 tax return. And they come back in 2024 and they say, okay, partnership, you owe this much money, and the partnership has to pay that out. Well, that partner had nothing to do with what happened back in 2021. But now part of their assets are being used to pay a tax bill for something that happened 3 years before they were even a partner in the partnership. So because of this, certain partnerships can elect out of this centralized partnership audit regime. In order to be eligible to do so, they have to meet some criteria. First of all, they have to have 100 or fewer partners. Secondly, the partners must be an individual, a C Corp, a foreign entity that would be treated as a C Corp if it were a domestic, an S Corp, or an estate of a deceased partner. So if you've got other kinds of partners, such as a trust, not on that list, such as a partnership, if you've got another partnership that's a partner, not on that list. So you cannot elect out of this centralized partnership audit regime. Also, there must be fewer than 100 K1s issued. For this purpose, the K1s issued by any S Corp that is a partner are added to the K1s issued by the partnership itself. So maybe the partnership has 80 partners, so that's under 100, so they're good there. But let's say 20 of those partners are S Corps, and those 20 S Corps issue a total of 50 K1s. Well, now you've got 80 K1s from the partnership itself, plus 50 K1s going to the S Corp shareholders. That's 130. So now you're over this 100 K1 mark and you cannot elect out. This election to elect out is made annually on the Form 1065. So you have to do it every year. It is not a one and done type of thing. So every year you have to say, we elect out. If you don't do that, then for that year, you will be subject to this regime. Any partnerships who are subject to this BBA, we usually just call it BBA, they cannot file an amended Form 1065. So if they have a change they need to make, they don't amend their 1065. Instead, they file something called an Administrative Adjustment Request, or AAR, in order to change those amounts and to report those items. So this is just a difference. If you have somebody that's not part of BBA, so they elected out, then if they have a change, they do file an amended Form 1065. But if you are part of BBA, then you file this AAR instead. A partnership representative. Under the BBA, partnerships are required to designate a partnership representative. There used to be something called a tax matters partner that was similar, but now it's called a partnership representative. The partnership representative has sole authority to act on behalf of the partnership before the IRS. They must have a substantial presence in the United States, and they must be designated on the Form 1065. So again, every year you have to designate who is the partnership representative. So that is the end of video 5. You may want to watch that one again. There was a lot packed in there. Read and study the slides and the IRS publications. In our next video, we are going to discuss C corporations. So I will see you in video 6.